Welcome, dear traders. Yesterday, US stocks snapped their losing streak and resumed an upward movement. Optimism was mainly fueled by the upbeat Manufacturing PMI report. However, Asian stock markets will hardly be able to recover given the rise in US dollar. The main bearish factor remains the same: monetary tightening by the Fed for a longer period than expected. The Manufacturing PMI report published yesterday was perceived by traders as a good news is a bad news. In August, the index totaled 52.8, unchanged from July. Yet the ISM Manufacturing Prices Subindex decreased to 52 from 60, logging the lowest reading since June 2020. Judging by the labor market and manufacturing data, the scenario of a soft landing still looks likely. Today, the Nonfarm Payrolls report is due. Analysts wonder whether its results will somewhat affect the Fed's hawkish stance. The likelihood is extremely small, as the watchdog's main priority is to tame inflation. Fed Bank of Atlanta President Raphael Bostic sees further rate hikes and says there is still a lot of work ahead to bring down inflation. He also added that the Fed has to slow the economy down to cap soaring consumer prices. Policymakers are well aware that aggressive tightening may cause slower economic growth, yet they are ready for it. It means that yesterday's publication of the Manufacturing PMI index, whose components have signaled a slowdown in economic expansion, has only bolstered a hawkish stance. US stock futures remained unchanged in the Asian session. The US dollar consolidated above 109.50 near its 20-year high. It has been rising for the third week in a row. Traders keep their long positions on the US dollar ahead of the Nonfarm Payrolls data. The US dollar is now moving in the sideways range between the resistance level of 109.61 and the support level of 109.28. Following Jerome Powell's hawkish speech at the Jackson Hole Symposium last Friday, the US dollar climbed by more than 1% versus its rivals, trading at 109.43. The bullish outlook also remains in force. The main drivers are sharp rate increases, the energy crisis in Europe, the economic downturn in China, and the high volatility in markets, which boosts demand for safe haven assets. The US government bond yields jumped to meet a rise in the greenback as the Bank of Japan keeps the Japanese bond yields close to zero. The yen has dipped again against the US dollar. The dollar-yen pair broke through the pivot level of 140 for the first time since 1998. Although a weak yen has some perks, there are also many drawbacks. For the export industries, it's beneficial, whereas for households and some businesses, the weak national currency has become a headache. It increases the cost of imports and adversely affects the standard of living in the country. Chief Cabinet Secretary Hirokazu Matsuno said today that the government is watching fluctuations in foreign exchange rates with a high sense of urgency. It's also ready to intervene if necessary. Bank of Japan board member Junka Nakagawa warned of risks to the country's fragile economy. To avoid them, the central bank needs to maintain an ultra-loose stance. However, many analysts believe that the pair will keep rising until US inflation begins to slow down. The divergence in the interest rates of the two central banks will continue to weigh on the yen and hinder the recovery of the Japanese economy. For example, Japan is now dealing with the higher costs for the steel imports, which in turn will affect the output cost. For small-sized firms, the import of metals becomes unprofitable due to the exchange rate. Despite temporary increases, the yen could decline lower in the near future. And today, the yen was supposed to rebound amid variable interventions and the consolidation of the US dollar. However, it did not happen. The pair was trading at 140.37, hovering near the downward channel of 139.84 and 140.43. The Fed's pledge to stick to aggressive tightening has significantly undermined risk sentiment in markets. Apart from that, the Aussie as a commodity currency lost steam following falling prices in the mining industry and the new lockdowns in China. On Thursday, one of China's biggest cities, Chengdu, announced a lockdown of its more than 21 million residents. Since the lockdowns of Shanghai in April, it has been the second lockdown of the megacity. At first, the USD pair decreased but then recovered to 0.6801. There are a few days left before the Reserve Bank of Australia meeting. Perhaps the pair managed to advance ahead of the meeting, trading in the range of 0.6781 and 0.6810. After a weekly decline of about 1%, the NZD-USD pair ended Friday's Asian session in the black. It reached a 27-month low of 0.6056, and today it's trading at 0.6884, moving in a bullish corridor of 0.6051 and 0.6090. The ECB and the Reserve Bank of Australia will hold their meetings next week. Investors are expecting new rate hikes. Today, they are looking forward for the Nonfarm Payrolls report. The economy is projected to add 300,000 new jobs. Soon we will find out the actual figures. And that's all for now. Stay tuned and do not miss our next video review. See you soon.